Last week we covered cost. This week we're going to cover profit. Profit. One of the key assumptions that economics courses make about firms is that the primary objective of a for-profit firm is to maximize profit. Profit is equal to total revenue minus total cost. In our daily conversation, when we mention profit 9 out of 10 times, we mean accounting profit. Accounting profit is pretty straightforward. For those of you who have taken accounting courses, so you know profits very well. Accounting profit is simply total revenue minus explicit costs. Explicit costs are input costs that require a direct outlay of money by the firm. So in the ledger or a bookkeeping of a company, you can easily see those items of expenses, such as the money that you spent on mortgaging, mortgage of a land or renting a land, salary and wages that you pay to workers, employees, interest that you pay to the creditors, and the rent that you pay to rent a machine or a factory. So accounting profit is total revenue minus all these explicit costs: cost of land, cost of labor, and cost of capital. But when it comes to business decision or economic decision, accounting profit is not always the best guide. Accounting profit does not include the cost of ownership or the cost of equity capital. So when resources or skills are allocated to a business, we have to consider the alternative. These resources and these skills could have been used in other business, could have been used elsewhere. So that means by allocating resources and skills in this particular business, the owners of these resources are giving up something elsewhere. So these are what we call the opportunity costs. In business applications, they are also called the cost of ownership, the cost of equity capital, or the cost or the implicit cost. So in short, economic profit is equal to accounting profit minus cost of equity capital, or since we have discussed earlier, accounting profit is total revenue minus explicit cost. So you can also rewrite economic profit as total revenue minus explicit cost minus implicit cost. We are using a lot of different terms to refer to the same thing. Cost of equity capital, which is also called cost of ownership, which is equivalent to implicit cost, which is also sometimes called opportunity cost. So why is economic profit a better guide in some of the decisions? So let's look at some of the examples. So here's an engineer, a very experienced and established engineer who works in a fairly large company. But his lifetime dream is to own his own restaurants. So this year he finally thinks that it's the time. So he starts to really seriously think about that. So he does all the budget planning, okay, and hopefully can make a decision or whether he really wants to start a restaurant and quit his job. So he does some research, and this is what he has found out. So this is his budget. So it is estimated that the total revenue of this restaurant is about $100,000 a month. And then he has to pay his employees wages and salaries, $30,000. The rent is a prime location, so the rent is pretty high, $20,000 per month. Food ingredients usually carries 1/3 of the revenue, which is pretty much the standard of the industry, $30,000. And then he borrows some money he plans to borrow some money from banks to finance some of the startup capital. So in return, he has to pay some interest, $5,000 a month. Okay. So total revenue minus all these costs. So these are what we call explicit costs, because you can actually see the outlay. Okay? You actually pay out of the pocket. Okay? So these are some of the examples of explicit cost. Total revenue minus all these costs will give us the accounting profit. So when you look at the number, $15,000 a month. Okay? So income of $15,000 a month. That's a pretty good deal, right? Okay, so it's not bad at all. You know, if you have if you have an income, okay, of $15,000, that's a pretty good deal. Okay, so what do you think? Should he quit the job as an engineer and start his own restaurant? So, in order to make this decision, there's another piece of information that we need. So when you look at this calculation here, everything else stays the same. We have total revenue minus all the explicit costs, and then we have accounting profit here. Okay, but there are a few other things that we need to consider. First, we need to consider his salary as an engineer. So he's a pretty experienced and established engineer in a large company. So after years of experience, so his salary is $20,000. Sounds about right. $20,000 for a seasoned and established engineer in a large company. So $20,000 a month. Okay? And he also plans to use $500,000 of his own saving to finance the startup of this restaurant. So if this $500,000 is put in an alternative investment, for example, a 10-year treasury bond, for example, on average, it will give him a 3% return. So when you break it down into 12 months, so he can expect to have $1,250 of interest or return from this $500,000 of principal. If he chooses to invest this $500,000 in a financial instrument instead of a business venture such as a restaurant. Okay? So these are costs. Okay? Although these are not really out of pocket, it's not a direct outlay of money. We don't see it in a ledger or bookkeeping, but these are costs, economically speaking. These are what we call the cost of equity capital, cost of ownership, implicit cost, or opportunity cost. Okay? So take, for example, salary as an engineer. This is definitely an opportunity cost. So he could have earned $20,000 elsewhere if he did not quit his job and start this restaurant business. Okay? So return on the principal on an alternative investment is also a type of opportunity cost or implicit cost, because he could have earned $1,250 elsewhere if he did not invest this $500,000 in this restaurant business. So accounting profit minus all these implicit cost or opportunity cost or cost of equity capital or cost of ownership, then you find that it is no longer a profit. It is actually a loss, $6,250. Okay? So if he had chosen, if he chose to start his own business as a restaurant and quit the job as an engineer, he would expect to incur a loss of $6,250 a month. Okay? So what do you think he should do? Should he quit his job and start his own business as a restaurant owner? So here's the thing. Some of you may say that, well, is his lifetime dream, so he should go for it. Okay? So yes, I mean, how do you put a price tag on a dream, on your lifetime dream? Okay? So these are some questions that only this engineer can answer himself. Okay? So the bottom line here is, if he thinks that his lifetime dream is worth losing $6,250 a month, okay, more than $70,000 a year, okay, then he should go for it. Okay? But he has to bear in mind that by choosing this decision, by choosing to run this restaurant, okay, he would expect to lose $6,250 a month. So he has to ask himself whether his lifetime dream is worth that much. Most of us would probably say no. Okay, so if that's the case, then he should continue to be an engineer, okay, instead of starting his own business.